if you're getting a score, if any consumer is getting a score for free, it's worthless.
How's it going? This is Josh Moody, and I'm here with Eddie Johansson with Credit Security Group, and we're going to discuss credit and how credit works with mortgages. And we're just going to talk about a lot of different credit stuff. And we're going to start off. I'm going to let Eddie introduce himself, how long he's been in the business. I've known Eddie for a long time. He's probably the best credit guy out there, especially in the mortgage world for mortgage credit to get into a home. But Eddie, tell him a little bit about yourself.
First of all, thank you for having me, Josh. It's an honor to be on your podcast, and I know we're going to have a good time today. My credit journey, in a nutshell, started about 23 years ago when my wife and I couldn't buy a home ourselves. I read every book possible about FICO scores, everything I could find. Come to find out, most of that I read was wrong. It's just people saying things that sound right, but they actually weren't true. So when that process failed, I just fell in love with the FICO scores, and I knew that every credit report was a perfect calculation of the score. The data was right in front of you, and I just was confident that over time I could figure it out. And having the pressure with working with loan officers such as yourself, and I got to be right. I don't have the luxury of being wrong. So you just get really good. It's been a fun 23 years. It's gone by really fast. Credit Security Group we started 21 years ago. About 14 years ago, I started working with a federal attorney, referring him business, and then he coaxed me, if you will, into being an expert in a case. And so I've done many cases since then, testified in trials, expert reports, depositions. And what's really cool about that process is I've been able to see what's behind the scenes, some hidden data that consumers are not allowed to see, which, is not right, but it is what it is. And so through that process and tens of thousands of before and afters, over 13,000 paid consultations, tons of phone calls, credit reports every day, all day. We just figured out what's possible. The key is to educate people like we're going to do today and tell people the truth. If their goal's not achievable or their time frame's not reasonable, and we can figure that out day one in a conversation, then everybody needs to know so that consumers can plan their lives. I think the worst thing that anybody in your world or mine can do is tell a family in January, hey, yeah, you can buy a home this summer. Well, they're going to plan their life around that. They're going to figure out school districts. They're going to get excited. And if you're wrong, well, then, and that's bad. It's not even the money or the time. It's the emotional crash that they go through. So there's a lot of pressure for you and for me every day to be right. And you can't go back to somebody with, oh, I didn't see this, or, oh, I didn't know that. It's our job. I mean, we cannot be wrong.
Well, I know that with working with you, and a lot of loan officers have something called Credit Assure, where they can click on a credit report, kind of tell them where points are. But in essence, what I found out is, like, working with Eddie, that Eddie's probably more accurate than that system. And so doing loans every day and making somebody go do something crazy to get the score up and make sure the loan's going to work. I'm not a type of loan officer that wants to send somebody out to go, hey, go do this, go do that, and you get a loan, because you're not always going to be 100% accurate. But with Eddie, throughout the years, it's been pretty right on 100% accurate, And that's one thing with working with clients, is that you don't want to be wrong, leave them down the way, spend some money, and then it doesn't work because they just won't be happy about that. But let me ask you something, Eddie, about scores, because I think that as a loan officer and people that go online to find their credit, and the number one call I get is, hey, my credit score is X, right? My credit score is 680. Then I pull the credit and it's a 620. Now, I've got pretty good of asking people, where did you find that score? Where was it at, right? So when I start knowing where it came from, Credit Karma, or it came from freecreditreport.com or wherever, then I already know I'm discounting the credit score by 30, 40 points of whatever they're seeing. But can you explain to everyone why those scores are different than what we pull in the mortgage world, and how maybe also people can actually go to find the real score, that they know what the score is when they're going to apply for a mortgage also?
Yeah, look, I get it a lot too. So there's a lot of credit scores out there, in general, I'll say if you're getting a score, if any consumer is getting a score for free, it's worthless. Meaning you'll never buy anything with a free score. So there's two main manufacturers, makers of scores. Everybody's heard of FICO, Fair Isaac and Company, and then there's the Vantage scores. The Vantage scores are what we see at Credit Karma and a lot of those monitoring services. So you can look and see, if you look closely next to the score, you'll see the name of it. It's called the Vantage score. It's just a very different scoring model. I've seen it way high. I've seen it way low. I've seen it closed. It's just going to be random. Now, when it comes to FICO scores, there's actually 40 FICO scores out there, and
Wow.
but there's only 3 sets that really we'll see in our lifetimes more commonly. When you go buy a car, there's the FICO 8 and the FICO 9 models, and those are the Auto 9 and Auto 8. I was with a client today. He's wanting to buy a car. He got an account at myfico.com. That's where we can get all these scores. And yes, you have to pay for them because they're of value. Go figure, right? And he had a auto charge off on there, and man, it was 100 points difference in his Auto 8 score versus the scores that you would pull for a mortgage. So those auto scores are going to really emphasize your auto history. They were designed for the auto world. So again, that's the Auto 8s and Auto 9s. Now, at myfico.com, they have the, quote, mortgage scores, and they're actually FICO models 5, 4, and 2. Those are the ones that you pull every day, Josh. Now, it's also important to note that these aren't the mortgage scores. These are simply the scores used by mortgage lenders. If you go to a bank directly for a business loan, a business line of credit, an auto loan with the bank, a home equity line of credit, a mortgage, a personal loan, just about any loan you can think of, they're going to use either all 3 or one of those 5, 4, and 2 scores. Now, those are the ones that dominate. They're the most widely used, and it's always important to go get those. I just had a referral today say, hey, I got my Credit Karma. Can you look at that? I said, no, I need to go look at your scores and your data at myFICO so we can know where we can have a benchmark of actually where we are. I've had clients go get myFICO, and we look at the scores, and they're ready. They're done. They're fine. Like, oh, what a great surprise. And just go get a loan. You don't need my help. I'm totally fine with that. But your credit cards and your banks will give you free FICO scores, and those are the FICO 8 score. Again, you're probably never going to buy anything with that score. It is very, very different from the scores used in mortgage lending. A free Experian.com account will give you the FICO 8 score. You can pay monthly with them to get the FICO 2 score. But for what you're paying, it's still better to go to myfico.com for $10 more a month. You're getting all the scores every single month. And so in summary, I know I've said a lot. If it's free, just don't even look at it. Don't take advice from it. If a bank's giving you a free or credit card, that's the 8 score, and mortgage lending is the 5, 4, and 2.
Why? This might be a question for a lot of people. Why do they have the different scores? Why don't they just have the same score for each bureau instead of having all these different models?
Well, good question. So, is the better frame this? The reporting agencies are a repository of data. I want to say there's almost 5,000 different what they call data furnishers, and that's your car, your student loans, your credit cards. All the people you see on your credit card are classified as data furnishers because they furnish data to the reporting agencies, and so there's different scoring models applied to that data. The Vantage score was created by the reporting agencies, and so it's cheaper. Fair Isaac charges a toll to score, so it's cheaper for them to use the Vantage scores and offer those. It's cheaper for monitoring services to offer those as well. Now, the main reason they have so many different scores is Fair Isaac and companies like, Ford or General Motors, they're going to come out with new models, get the new Escalade, the new body style. And so throughout the years, they've come out with new scores. The first score ever born was Beacon for Equifax in 1989. And then in the mid-90s, these mortgage scores were adopted by Fannie and Freddie. FICO '08 came out in 2008, and then they had the FICO 9 scores, and now the FICO 10 scores are out. Now, it's interesting too, Josh, and you'll find this curious. I've recently got wind, if you will, that we might see a shift in going into the FICO 10 scores for mortgage lending. I also understand, which I was surprised about, is that Fannie and Freddie are accepting the 10 score in their automated underwriting systems. I haven't validated that, but I got it from a pretty credible source. And I'd also like to say, man, I just can't tell you over the past 23 years how many news articles or alerts, oh, they're coming out with a new score, and this is going to be different, and that's going to be different, and it never happened. So many times this is going to happen. It didn't happen. Oh my God, this is going to happen. It didn't happen. And I would get so many emails from loan officers and consumers. And what about this? So years ago, I adopted the philosophy of I'll believe it when I see it. But it is pretty interesting. They're trying to get away from these older models. I don't have a lot of experience in the 10s. I'm starting to look at all of those now and compare them to the scores every chance I get to start to learn them. But they'll still be FICO models. They're just going to be a little bit different. It's just different scores for different industries. And it's my opinion only that I think Fannie and Freddie are hesitant to switch because they have so much historical data on these three scores. I mean, Josh, you're a business mind, a brilliant business mind. I mean, imagine having all that data and then one day going, okay, new score. What are the tiers?
Right.
I mean, what's a default rate? And if the default rate changed just because of economics, you would then think, oh my God, it's the score. You know what I'm saying? It would just be a wild thing.
Well, tell me if I'm wrong though. Like when you go to a car lot, what model is the car lot going to pull, or do you really know what they're really pulling? Because they usually have higher scores.
It depends. So it's going to be the Auto 8 and Auto 9 FICO scores. And
Got it.
And it's an auto enhance, so the score really looks at your auto history. So it just makes sense that if you have a bunch of perfectly paid cars, then it's going to be a little bit higher than potentially your mortgage score. A lot of times I see them really similar unless you have a repossession or an unpaid auto charge off or, something dramatically derogatory or recent on an auto loan is when I really see a big difference between those scores. But if you have good credit and it's all similar, meaning if you have lates, it's kind of on different things and not necessarily with an auto, then we'll find that the FICO scores, the mortgage scores, we'll call them, and the auto scores track pretty close, maybe 20, 30 points apart, but there won't be a dramatic difference.
And I know the answer to this, but I'm going to ask you. So what is credit? Why do people use it?
Well, I mean, there's always been a big discussion of we need to have a different system. And my question is, well, what is it? We in America, we want fast decisions. Look at what you do every day. You get a loan application, you pull credit, you put everything in there, you run the automated underwriting system, and in 15 minutes, you have an approved loan. Now, humans have to verify everything you put in there and document it, but you did that in fast. And so it allows for quick decisions, quick buying opportunities. And so it's there. Plus, credit is needed because every time a lender is doing a loan with the consumer is a stranger. So how do you check on a stranger? Well, let's see how they've paid other people in the past. And that's really where credit started. It's a really interesting story. The first credit report ever, I want to say it's in the early 1800s. Well, no, early 1900s. And there was a general store. And, back then farming was crops is when you got paid, but you needed equipment and seeds and things before. So this general store would give farmers credit. And they actually sent people to their farm to see how they kept up their farm, how they kept up with their equipment, to see if they were a risk. In other words, were they going to produce a crop to pay them back? And so this general store started building this list of farmers, and he was giving them credit based on a rating he had created. Well, guess what? Other merchants in town said, hey, man, can I get that list from you? And he's like, I'll sell it to you. And that's where that first credit report came from. It was really localized for years and years and years. It was localized, meaning in a state or in an area about that size. Like, SARMA, right?
Right.
Okay, so that's San Antonio Retail Merchant Association. Do they hit 100 years old in the past 5 years? That's how long they've been around. So when they started, they were just a local credit bureau. I also met this fascinating woman, Heather, in Idaho. Her grandfather had a credit reporting agency in that area, and she even has an old credit book that was sold, and it had people's name in it, and they were rated A, B, C, D, and they would have supplement pages as things changed, and all the local merchants would buy a book from him. They would report back to him, and they'd manually keep track of people. So it's just a way to give credit to a stranger and be able to assess them. The whole goal is, can you pay as agreed? And you really got to be perfect. There's no boo-boos in the credit world. There's really, if you're at least over 620, 30, and all the way up to 800, anything negative is a bomb. I mean, it's going to be 40 to 60 points. I mean, if you're,
And let's go into that. The credit report is mainly made up of what kind of accounts? Revolving installments, correct?
correct. Yeah, you have revolving installment. And we don't need to go into open accounts. The American Expresses you have to pay in full each month?
Yeah.
Okay, those are open type accounts, meaning they're balanced monthly accounts. It's not revolving each month. You're carrying a balance. It's not an installment account that has a set period of time like an auto loan. It's open, meaning you have to pay the balance in full each month. So we have original creditors, revolving installment, and some rare open type accounts. And then we'll have collections, which are just collection companies. And then we'll have the public records section. And the public records now is just bankruptcies. And then, of course, inquiries. And those are the main, with FICO scoring. Beyond that, you'll have your personal identifiers. Your name, like, I'm Eddie Johansson. My birth name's Edwin Escher Johansson. So both of my names are on there. My current address, my past addresses, maybe my phone number. So those identifiers is what happens with how a credit report is pulled. What's really interesting is we don't necessarily have a file at the reporting agencies. It's a sea of data. So when you were to pull my credit report, let's say, it'll take my name, aliases, all my addresses, my social, date of birth, and it will search through every single account and build a credit report of those data furnishers, of all those companies I've ever dealt with. And then FICO scores it. And what's amazing, man, is all of that happens in less than a second.
Crazy.
It's wicked fast. I've got a gentleman I've really gotten to know that is experienced for a long time, and we've had some super geeky conversations, man. And it's been fun to learn all this and see inside, how that works and how it all fits together.
Let's just go into revolving. And on a revolving account, what is the correct balance to carry on a credit report? And I understand, like for me on my credit cards, I pay them off every month, right? But unfortunately, they only report at the worst time of the month, right? So they're always going to show a balance, even if I do pay them off. That's why when I pull credit, people are like, I pay my credit card off every month. There isn't a balance. But that's just because they report at the worst time, right?
Well, kind of. So I'll predicate two things. One, we should prepare for purchases. We should be sure our data is right, because we have a mortgage coming. Man, if you think about the average consumer, well, you tell me, let's add up all the homes and all the cars an average consumer would buy from 18 to death. How many do you think it is?
Probably maybe three to five, maybe.
3 to 5 homes, 3 to 5 cars. What's that, like maybe 10 times in your life you need to prepare
Probably
for?
more cars, but yeah.
Yeah. So 10 to 15 times in your life, you need to be ready. If we were back in high school and the prom was on Saturday, we're going to look good that day. So it's the same thing when a lender pulls a credit report. So with that in mind, we prepare for purchases. Now, revolving accounts, credit card companies report your statement balance. Your statement just ended, and then they report. So they're going to report that higher balance because that's your statement balance. And then your due dates after that. So I'm not a huge fan of people trying to beat the reporting cycle. If you have bill paying habits and they're ingrained, I'm always skeptical and scared of people changing the bill paying habits. I mean, if you want to have a fun conversation with a group of friends next time you're having a dinner party, ask each of them how they pay their bills from the mailbox or how they pay them or how they keep track of them. Everybody's going to be different. It's wild.
Right.
So the best thing to do is, okay, Josh, I'm going to sell my home and buy my home this fall. I know you're going to be pulling my credit in September. So July, mid-July, I'm getting my credit cards down. In a perfect world, I would have one credit card with a small balance, less than 5% of my limit, not zero, but the rest of the cards at zero. Now, a lot of people say, Kip, $10 on every single card. Not true. So I would do all
So
that.
just one?
Just one with a token balance, yes. So then, and say I do that mid-July. Well, now I'm monitoring my credit. Nothing wrong with Credit Karma for monitoring data or a free Experian account or whatever you're using to monitor the data. Just remember to ignore the scores. Once I see all those cards update, I'm going to go to myfico.com. I'm going to buy my scores. I'm going to be an 802, and I'm going to call you up and say, hey, Josh, I'm an 802. And you're going to pull my credit and go, you're right, you're an 802. I'm like, no shit. I just prepare for this purchase. I'm not surprised by what you're about to get. And so that's the best way to prepare. Now, if I wasn't going to buy this hypothetical home this year, and you said, Eddie, when are you going to buy a home? Well, about 5 years when my son's out of high school. Well, then I could have maxed out credit cards every single day until 45 days before then. No, it wouldn't be smart financially. I'm paying interest, but I wouldn't care that my 800 was a 710 because all my credit cards are maxed out. So we don't have to be so conscious of what our data is every single day. And what's my score? What's my score? What's my score? We need to be conscious of, are we paying as agreed? Are we paying on time? Are we avoiding inquiries? Are we trying not to get too much debt, too many accounts with balances, too little money in the bank to where we can't adjust with cash our balances? That's the most important things consumers need to do between purchases is nothing negative and be sure they have enough money to pay things down when they need to. Now, they don't have to. I mean, you know that if I'm over 740, I'm going to get, almost the best loan possible. Yeah. I mean, 760, 780 is what, an eighth of a point at each level, maybe?
I think once you hit 740 plus, there's not much different. In some cases, there is in some loans.
So if I'm a 743 and I have a Nebraska Furniture Mart, let's just say, and it's kind of maxed out, but I got 0% for 18 months. Well, I mean, I don't have to pay that down because you're telling me my 743 is fine. So everything is so situational, and that's what I'm doing every day. I'm having anywhere from 4 to 8 phone calls a day. What are your goals? How much home you want to buy? How much you going to put down? I'm trying to figure out the loan program, unless you've told me what you need, which I love about when you refer people to me, just tell me what you need. And then when's your lease up? How much your down payment you have saved up? So when do we need to be where? And what do you need to be at? I think a lot of people think they have to be a 700 and put 20% down. I'm like, no, 623.
Well, let me ask you one question revolving. If someone has perfect credit, no lates, no collections, and those cards they have 2 credit cards and they're maxed out, how much would that impact the score?
Well, boy, easily 80, 90, not quite 100. If it was just 2, now if it was 8 or 9 of them that are really high, then yeah, it can be up to 100 points.
Now let's go into one late on a credit report, let's say a credit card. How much would that impact the score?
If we have perfect credit and we have, let's say, a 790 score, right? There's nothing negative, revolving or good, make a little mistake, get a 30-day late. Oh man, that high of a score, 50.
A common thing I always see is someone has a credit card and they got that $50 fee to have that card per year, and they forget about it because it's not a card they use on a regular basis, and that becomes late.
Yeah.
How much would that little bitty just $50 late
Well,
affect it?
50 to 70 points.
It's crazy.
And you'll get half of those back slowly but surely up to around the 2-year mark. You'll get the rest of them back over the next 5 years because negatives stay for 7 years, and you will not be allowed to be in the 800s as long as you have any spec in negative. So, if somebody's at 680 and they have nothing negative and they get a 30-day late, it's impactful. What's really cool about FICO scores is it's layered risk. In other words, I had a woman who lost over 90 points with a 30-day late. But, Josh, she had 3 credit cards a little bit over the limit. So when that 30-day late hit, it was catastrophic. I have a kind of a silly analogy, but it gets the point across. When you have those credit cards that high and the FICO score is like, oh my God, he broke, she's broke, but she's paying on time, but she's broke. Oh my God, could she be filing bankruptcy? Oh my God, she doesn't have any money. She's broke. And as soon as that 30 hits, oh my God, here it comes, 30, 60, 90, 120, oh my God. And so the score freaks out. It was a huge impact. Now, just to kind of preface this, since we're talking about FICO scores, in April of 2004, Fair Isaac told the world that the purpose of their score was to predict the likelihood of a 90-day default in the next 24 months. So that number represents the probability that a consumer is going to be 90 days late on anything in the next 24 months. So recent behavior becomes paramount for predicting future recent behavior. So the reason that 30-day late hurts so much is because it just happened. But we take that same 30-day late and we throw it 6 years ago, it hurts, but not nowhere a fraction of what it did last month, 2 months ago, 3 months ago, in this super recent time period.
Well, let's just say they had a 30-day late and they continue down the road. How many points would they start getting back, 6 months from that 30-day late?
It's hard. There's a lot of other factors in the score, but, the scores will, if that's 50 to 70 points, 6 months later, you might get 10 of them back, 10, 12. Not a lot. I mean, what we're doing in that scenario when I meet people with like that is, look, the late payment's there. It's not going anywhere. Don't waste your money with credit repair companies, or if you want to go dispute it, that's fine. The average investigation at the reporting agencies is probably 30 to 60 seconds. They just look in the computer and go, yep, you were late. Like, dang, you got me. It's kind of like me saying, Josh, the sky isn't blue. And you go, yeah, it is. You're like, oh, you got me. So that whole disputing thing, people shouldn't pay credit repair companies. Don't do that whole dispute machine thing. It's a mess. Let's live in the reality of it's there. It's going to stay there. So what else are we going to do? Where else can we get points? And generally, the other place to get points is debt. Less debt.
Well, the other common thing that I see, for instance, someone calls me and they tell me their credit's perfect, right? Again, they didn't check it or anything. And I pull their credit and they have perfect credit, but they had a $50 medical collection and their score is in the high 600s or mid 600s. And they lose it over it, right? But typically you can help them with something like that. But I mean, that's something that common that they forget. That's like with me having kids and you get little bills here and there from the insurance company that didn't cover completely or whatever. And for me, seeing that every day happen to people, like I'm on it. Like, oh, I got to go pay this $50,
Me too, man.
They will send me a collection. So that impacts over 100 points too, right? Just having a collection just pop up from a medical collection?
Well, so all collections are the same. So we could simply use the analogy of a $90 Spectrum collection or whatever. So if a consumer has perfect credit, nothing negative at all, that collection just hit, then it's going to be 85 to 95 points because it exists. In other words, if you pay it really fast and it goes to zero, you don't even get one of those points back. It is still there. And dollar amounts individually are not influencing scores. So if that's a $90 collection or a $9,000 collection, that difference is not going to influence the scores. And we can spread that out broadly. $1 million mortgage doesn't influence a score more than $100,000 mortgage, an $80,000 car, an $8,000 car, a $10,000 credit card limit's no different than a $5,000 credit card. That's a more myth out there. And if you think about it, it makes sense. Somebody with an extremely high income still has to pay as agreed to have high scores. And just because somebody has a lower income and they can't buy big things, as long as they pay as agreed, live within their means, keep their debts down, they can be an 800 too. I mean, I'm sure you've pulled some 800 on people that didn't make a lot of money.
Correct.
Yeah, because they can pay their bills. They're bill paying machines.
Right.
So it's going to come down to the event itself. Now, diving into collections a little bit more, you got to be really careful. There's a lot of collection companies that are consumer friendly. I think the vast majority aren't. And when I mean consumer friendly is when they call and say, "Oh, we'll pay you if you delete it," which I'm not a fan of. It's credit bartering. A lot of the companies will shy away from it. Will they delete it for other valid reasons? Most of the time. So it's the approach. It's the conversation. You know, when a consumer has just one inquiry, man, I've taken a page of notes on that thing before because I want somebody inside my company who knows what they're doing to approach the company properly. And we're going to pay the debt. I mean, we're not going to argue that. You know, even if it's not right, we're going to pay the debt. You know, I know some people are probably cringing, like, what do you mean if it's not right? Well, look, I mean, you can stand on principle. It's a free country. We can. But it's such a battle to win those. It is so time consuming. And even if you had absolutely perfect documentation, we could dream of the best documentation possible, and you perfectly dispute it under the Fair Credit Reporting Act. I mean, you just record every phone call. I mean, it's just gorgeous, but it's still there. Your next thing is to find a federal attorney. They sue them, and now it's up to 18 months in the federal court. Or we could just bite the bullet, kill the debt, get the home, and move on. So that's another thing we preach to people is don't stand on principle. Like that little $50 medical bill you mentioned that, you know, comes in the mail.
And I've had people like that, you know, about the, let's say a $50 collection, and they're like principal to them, then they're not going to pay it. And when I have to let them know that, well, this affects your credit by 100 points, I mean, they go berserk about it. But really, there's not much they can do, right? I mean, it's getting with you and trying to figure something out, but still, I mean, that to get those 100 points back is not an easy feat.
Look, I mean, I don't want to paint the picture that there's nothing anybody can do. I mean, the laws are there to help consumers. You can find evidence and fight things. I think the biggest problem out there is that most of these debts are accurate. And if you have a technicality and you're 1 in 1,000 and you're right, but 500 of those 1,000 are saying, I don't know that. That's not my debt. You know, so the honest people or the people who really are telling the truth can get lost in the mix, and you don't get a lot of attention. And, you know, there's no police in the credit world. Nobody's going to get arrested or go to jail for reporting someone on your credit report. So since it's all civil, I think these collection companies are a little more lax. They're not too scared. And although a lot of consumers threaten attorneys, and not many people go find them and do them and pay them or find an attorney that will represent them at no cost. So to me, it's time. You know, I've had clients in the past that went nuts, just like you mentioned, over like $200. And dude, they spent so much time fearing over this, hours. I'm like, man, do you make more than $20 an hour? He's like, yes. I'm like, well, you're burning your time. And I talked to the wife, and I'm like, are you tired of this? And he's like, oh my God, I'm so tired of hearing about this collection. I told him we should have paid it a long time ago. And so it's just funny. And I find that it's more men. I think we men will get on principle and be like, no, you know, and hunker down when the best thing you do is get it off and get a great mortgage loan, because that's way more money on the table.
Right. Going into, and that's one thing with somebody that calls me that has, let's just say, lower credit scores, and they're trying to get their score up and they have money to pay stuff. I always stop them and say, hey, wait, you need to call an expert to go over this, because what I don't want you to do is go waste your money paying certain things, and then you call me back the next month and your score is exactly the same, because paying that collection to zero may do no impact to the score at all. And obviously, working with you for a long time, that, paying off a charge off credit card might be freaking the score out, where that might have impact. But my thing is, they need to talk to somebody like yourself to make sure they have a game plan together and you can predict the score of what it's going to be on the things that they do, than me just letting somebody go crazy paying everything. Because I've seen some people just go pay everything off and call me back, and the score really didn't move much.
Yeah, no, you're right. My goal for all these years, beyond getting a borrower back to a lender to close a loan, I mean, that's been our what do you call it? Not mantra, but our company slogan.
Motto?
Yeah, our motto since we started this company in 2004. And my goal with each consumer is for them to not need me in the future. I want them to know how to play the game. They watch our FICO video. We go through the credit report. I can make any individual person an expert of their report. I just can't make them an expert of everybody's. That's hard. But
Right.
once they see it and how it's structured and how that data fits into that score, man, this light bulb goes off. It's so much fun. And then when I give them the plan, it makes perfect sense. So we're trying to use the least amount of funds in the shortest period of time to get that borrower approved. We do get referrals from our clients, but a lot of people don't talk about that kind of stuff. So we really rely heavily on you to refer us business. We got to continue to get people back to you to close loans. You can't have any problems or complaints. I tell the girls in the office all the time, I mean, we're in the expectations business. And we got to overpromise. We got to underpromise and overdeliver. We just have to be right and be sure we're advising people right. But in a nutshell, you're correct, man. Let's put money in the right places, and it's really easy to waste money and time. And even if there's another whole side of this that I can see consumers fall on. When I have a single meeting with a consumer, do these 4 things. They're all doable. We've been keeping track of every single company that reports on a credit report for 18 years in a database. It's like fantasy football. I know all the players. When I go through that credit report, I can tell by the names of the company and who they're collecting for or what's reporting. It's just like players. So my brain, I just know immediately what is and isn't possible. So I can put a consumer on something knowing that they can do everything I tell them. So I say, look, do these things. Get them done now. Monitor your data. Come back to me and let's look at new scores. Well, when they come back, man, this didn't update over here. That hadn't updated over there. This isn't quite done yet. So there's this whole side of this monitoring that is really key. That's the reason I always push people to get into our plan software, to where I can put those action items in our software. I can then send them the email, and then my team stays with them until they're done. We mark them done, and then we're tracking data on every reporting agency till it's perfect, and then we check scores. And then that's how we can see peak scores. As you know, 50 to 100% of our fees are due after we hit the score goal. There's no company out there in the country that does that.
You're the only one I know that does the score contracts where you hit the score.
Yeah.
Most people aren't like that.
No, well, because they don't have the confidence. And look, I don't want you to pay me in full unless I did something significant in your life.
Right.
Like help you buy a home. I have this old saying, nobody's ever excited about almost buying a home.
Right.
It doesn't matter. And, I had a tough conversation with a gentleman yesterday. He was referred to me, super nice guy, man. He's working his butt off. And he was just 60 days late on the credit card on top of a whole bunch of negative history. He's like a 507. He's wanting to buy a home in August. And I just told him, man, I said, you're not going to be able to. And there's a good chance it's going to be hard for you to buy a home next August. Just based on what he had on his credit report and the amount of money that was going to be needed and the amount of free money he had. But he appreciated the call. I do a lot of quick calls. We call them that are at no charge, just to kind of figure out where somebody is. And I just tell them the truth. Further in that conversation, he's paying $2,500 a month in rent for a 3,000 square foot house. I'm like, well, man, that ain't bad. Because if you go to buy a house that big,
Right.
It's going to be a heck of a lot more than that.
Right. Well, I'm going to go through a few questions here on public records. Do they affect the score?
Yes, yes. You'll probably remember back in the past, we would see tax liens, judgments, and bankruptcies. But I
Right.
think it was the summer of either 16 and 17 or 17 and 18 that the reporting agencies just got out of the judgments and tax liens business. And I think mainly just my opinion is that all these courthouses, all these county courts, and all these towns just didn't have the best data. They may have your name and address, but not your social. And there really was no way to do an investigation, which is mandated by the Fair Credit Reporting Act, because no clerk's going to go pull a record and get 500 investigations a day. The county just can't foot it, so they just said, you know what, we're out. We're not going to look at those. We're just not going to report them, but they're going to report bankruptcies, and that's where LexisNexis became a huge mandate for their service, and that's why you're pulling credit reports, that supplemental report in the middle of and when you originate a loan, just to be sure there's no judgments and tax liens. And I think that's important for consumers to know. Just because Equifax, TransUnion, and Experian does not show your federal tax lien or your judgment, you still need to take care of it because lenders are going to find
It will pop up in the back. Yeah.
Right. And by then it's kind of late. It's really hard to get a judgment satisfied in a court in that 30-day period.
So really just the only public records that they report on their reports now, you're saying, is just the bankruptcies?
Just the bankruptcies, yes. And
So next question, child support, does it affect the credit scores?
No.
A lot of people don't know that.
Yeah, so child support's not an extension of credit. So it's there for what they term credit worthiness, meaning your underwriters can see it, people can see it, but it's not in the scores. And I got another one for you, man, and I'll give you this little piece of gold, Josh, and all your listeners. Rental agreements are not in scores. So all these companies that are selling you, hey, we'll report your apartment rent, we'll report your rent, pay us. It's not in scores.
Yeah.
And what's really interesting about that is, we started seeing rental agreements being reported. And it says on their rental agreement, like it would in the same place, it would say auto lease, mortgage, or in that same type of account description. And man, about 15 years ago, and I just kept seeing those. I would see them with negative history. I would see them really recently open, and I just wasn't feeling that it was affecting the scores. But what we've done for this past 23 years, me and my team, is we never say something is true until we see something perfectly isolated. In other words, it's on a credit report, it's undeniable. Until then, it's just a theory. And for years and years and years, and it was just last year, man, and this is so geeky, but I was so excited. There was a perfectly paid rental agreement from several years ago on all three bureaus. And then the only other account on that credit report was a credit card that was 2 months old, and they didn't have any scores. See,
It was zero impact.
they didn't have any scores. So if that had been an auto loan from several years ago, bam, they'd have had scores as soon as that credit card hit. So that was the perfect isolation. I emailed everybody in the company, look, man, there it is. So they're just not in scores. And again, a rental agreement is not an extension of credit.
The other thing I see is utility bills. Where are they getting? Sometimes I get a credit pull the other day, just yesterday, and it had like 10 utility bills, which I took them all, take them out of the debt ratio, but they reported them. Is that having any impact to the score either?
Yeah, look, a collection is a collection, whether it's a utility bill.
No, I'm just saying they're just reporting utility bills like they've been paying on time. I don't know who's doing it. You know what I'm talking about?
Yeah. No, okay. So what you're talking about is Experian score boost. So if you look at those closer, you'll see that all of those are just on Experian. Okay.
But does it do anything to the score with Experian?
No, not the FICO score 2 that you pull. It's not in the scores. But it does help the FICO 8 score. And, I don't want to say that you'll never use the FICO 8 score. I know that PNC Bank, when they do a HELOC, uses the FICO 2 score only, so that's pretty rare. But I would like to say that if a consumer is buying a home or a car 99.9% of the time, it's going to be the FICO Auto 8 at a dealership or the 5, 4, and 2 directly with a bank or credit union, and these scores just dominate. So, and man, I was an expert witness in a case in Florida, and so they had a whole lot of denials, and of the 8 auto loan denials, 1 was from a credit union, and they were using the Vantage score. So I don't want to make it appear that nobody's using the Vantage score. But it's just the high probability that it's going to be the FICO scores that are going to be used.
Well, let's go into one of our last questions, and we won't keep you for too long. What is the myth about building credit? Everybody wants to go build credit, and they just go crazy. So
Stop.
they want to go open a 15 accounts to build credit.
Man, let me pull out my soapbox, man.
I mean, what if someone has a 0 FICO score, a 0 score? What do you recommend to build their credit?
Well, first of all, there's no such thing as a 0 score. There's just no score, okay? Now,
Right.
The only time people, if we're going to use the term technically, the only time people build credit is when they're 18, okay? Everybody who's older than that has to deal with what they've, quote unquote, built, their history. So when I hear about building credit, what I call building credit is a consumer has a history. They've got some negative things. They've got some collections. They've got some debt, student loans, car. They have debt, and their solution that is propagandized out there everywhere is that the way you're going to increase your scores is by opening up new accounts. You're building credit. It sounds wonderful, but every new account lowers your scores. Think about this. What's the likelihood of a 90-day default in the next 24 months if somebody just opened up 4 or 5 accounts? What did those 4 or 5 accounts really mean? They didn't have any money. It meant they were broke and they needed credit. Well, if you appear broke, you're going to have a lower score and have a higher likelihood of future default. I'll give you an interesting factoid, man. FICO High Achievers is a term that Fair Isaac's been using for years, and they'll talk about some characteristics of people with high scores. And not every FICO High Achiever characteristic is held by everybody with a high score. It's just commonalities. One of them is FICO High Achievers have an average age of 10 years per account. Average age. So that means they never open up new accounts. Think about this. If you go a year or 2 or 3 and don't open up a new account, if you don't need credit, what does that mean?
It means credit should be good.
Well, no. How are you buying things then without credit?
I'm just saying, if you still had some accounts open that were going, you had a credit card and you're not borrowing any money.
Right, but
you're still using your card and paying it off. You're saying not using any credit whatsoever.
No. What I'm saying is somebody who goes a long period of time without opening up a new line of credit means they just have money to buy things.
Right.
They're buying the thing. They're buying vacations. They're doing things with money. They're buying groceries with money. I'm not saying that somebody should have no credit. I'm just saying that a whole bunch of credit's not needed. I'll give you a scenario. Let's say that somebody has 10 accounts with balances. Every year, they have multiple inquiries. They open up 2 or 3, 4 new accounts. They pay off 2 or 3, 4 accounts. They're making these quote unquote payments every single month, and they think they're building credit. Look at me. Look at this. And FICO says, oh my gosh, you're broke all the time. You're a risk.
If you looked at let me ask you this, go back to this other direction. If you looked at a perfect credit report, or if you wanted someone to have a perfect credit report, what would be on that report when you pull it and say, that is a perfect report?
Ooh,
what would be on that report?
That's a good question. Okay. So, all right. Well, I'll just build it. It's almost all the FICO High Achiever things. The oldest account's 25 years old. The oldest revolving account is 20 years old. You don't have more than 6 accounts that are open. Only 3 of those 6 accounts will have balances. You'll only have 1 credit card where the balance will be less than 5% of the limit. You'll have 0 inquiries in the past 12 months. And your open installment accounts that you have, like your mortgage or your car, are mature, meaning you owe less than 85% of whatever that high balance was. That, my friend, all the scores are over 800.
Well, and then going back, this other question I have for you, somebody that is older, right? They stop, they're retired. They're not going to borrow any more money. They just stop completely,
this one.
even with credit cards. How long does it take if they stop borrowing money or doing anything before they had a 780, let's just say, and all of a sudden they go to a no score? How long does it take before your credit goes dormant before you lose a no score?
6 months. 6 months of no payment history. Now,
6 months.
6 months. Maybe the seventh cycle, 6 reportings of no payment history. Now, what I would tell that person, and I've had this conversation a lot. I'm retired. My home's paid for. I'll just pay cash for cars. I've always been in the 800s. I'm worried about losing my score. I said, man, keep one credit card. Use it for a tank of gas once a month, pay it in full. You could do Netflix for $13 and just let it auto pay. And then that payment history is all you need. See, that's where people complicate this. Do one account. That's it. And some payment history, dude, you're in the 800s. Less debt is less risk. Less accounts with balances is less risk. More mature installment accounts that have been paid down a lot is less risk. More debt, more accounts, more new accounts is risk and risk and risk. And that's why this whole building credit thing drives me crazy. Every single day, Josh, I'm looking at a credit report. I'm seeing what's possible. I'm calculating the score they can get to, and they're coming up short. Why? They opened up 5 or 6 accounts in the past 8 months because they thought they were building credit. And all these websites say, hey, you're approved for a credit card. You might be able to increase your scores by building credit. Oh, really? Oh, let me get this credit card. They just get all this debt. And you can't.
Yeah, it's like the one that Chime card. I see that on a lot of people's credit reports.
That thing drives me crazy.
Does that even impact the score?
Yeah, so here's what drives me crazy about the Chime card. Not all of them, but the one specifically is it says credit card, but it's an open type account. So it's not revolving. So people have that thinking they have a revolving account that's triggering revolving. Look at me, I'm playing the credit card game, and they're not. It's an open type account. If you look at it, you'll see open, but they'll have words in there almost like a comment credit card or a secured credit card. But if you look at it closer, you'll see open, or you won't see a limit on it. And that's the way to tell. And look, I'm not trying to disparage these new companies, Chime and Kickoff and all these companies that are out there. It's my opinion that the game they're playing is let us hold your money while you build credit. And that's okay, but there's nothing.
And that type of account is not having the same impact as a true credit card.
Correct. Now, if you only, I saw one just this past week. They've had a Chime open for 3 or 4 years, and that's really all they had. Well, it's still history. It's not bad. It's just more like an installment account. It's just look at it more like an installment history. And I told that person to go get a credit card, a real one, and so that Chime wasn't bad, and the Kickoff's not bad either. I'm not trying to disparage these companies. It's just. There really is no quote unquote new way to do things. Hey man, I got one fun for you. Did you know that there's no such thing as payments, number of payments, or even payments made in FICO scores?
I wouldn't know that, no.
See, if you think about a credit report, envision a trade line in your brain. All you see on
it does say on there like 99 payments. You know, when it hits 99, it kind of stops.
Okay, so what you picked up on, that's months rated. So that's how many months it's been reported.
Okay, that's what I meant. With time. With the time.
Yeah. And then we either have 30, 60, or 90 days late. So I'll give you a good example. If I opened up a credit card a year ago and I didn't use it at all, I put $10 on it last month, and it just reported $10 today. So it's 1 year old. I've never been 30, 60, or 90 days late, and the balance is $10. Now, let's say I opened up that same credit card. I maxed it out every single week. I made 48 payments on that credit card, and my 48th payment last month, I paid it to $10. Well, guess what? Today, it is $10. It's never been late, and it's 12 months old. So there's no payment counter. These people who have 10 accounts of balance and look at me, I'm making all these payments each month. It's not that. It's how old are your accounts? Have you ever been late? What's your average age of accounts? How many accounts of balances do you have? It's looking at it that way.
Well, okay, let's go this thing with revolving. Someone's got 10 credit cards. They pay off all of them. They only have. Do you recommend them close those part of those 10, or just let them die off when
Well,
the card ends up canceling?
Well, two things pop in my mind, and you talked about this earlier in our conversation about that $50 yearly fee that hit that credit card, right? The guy didn't know.
Right.
So I tell everybody, if you have an open credit card, you're responsible to log into it every single month and confirm it's still zero, it's still zero, it's still zero. You have to, just so you can catch that $50 thing. Now, if a consumer has 10 credit cards and they want to close some of them, they can. This whole never close a credit card. Oh my God, never close a credit card. It's been so overemphasized. When you close a credit card, it does stop aging one little month at a time. It goes into your closed section. It's still in your scores. And could you affect your average age of your accounts over the long term? Yeah, but gosh, that's such a small part of your score. It's fractional. It's a lot better than paying a credit card an $8 monthly fee because it was a secured card 5 years ago and you got your foot in the door. Now you have much better cards. Close that thing down. You're done. It served its purpose. So the only time a consumer would really hurt themselves is they just closed every credit card down, because then they would have none.
Right. So it's best, in my opinion, keep the oldest ones, right?
You can, but FICO's still going to see that open date, and it's still going to be in your history for 10 years. So,
Okay.
The average age, well, my brain's going to block, but I think,
But going back, you're saying collections fall off in 7, the credit report?
yeah. So interesting there is that,
And the closed accounts don't fall off for 10 years?
correct. Yeah, so if anything negative, anything individually negative is 7 years. Like if you're 30-day late, that month will fall off 7 years later. The only thing that's more than 7 years is a Chapter 7 bankruptcy, and that's 10 years from the file date. Now, while we're talking about the 7-year mark, there's this big myth out there about activity, right? Paying it as activity, calling them as activity. With this activity, you can change the date. It can last longer. So that's not true. The date that drives the 7-year clock is the first date of delinquency. If I stop paying my credit card this month and it went 30 days late next month, 30, 60, 90, 120, 150, charge off. My first date of delinquency is next month. That's going to start the 7-year clock. If that credit card's charged off for 6 to 12 months, Midland Credit Management buys it. Their open date's going to be January of 26. It is still the first date of delinquency is still next month. See what I'm saying? Doesn't matter how many times a debt is bought, sold, used. You can pay on it. You don't pay on it. You leave it alone. That 7-year date never changes.
So that means that credit card that charged off, that trade line would delete after 7 years. But if you had a credit card that you closed that was in good standing, that's going to report for 10.
Correct. Yeah.
So
and even if that credit,
have you seen where a collection company buys the charge-off account from, let's say, Capital One, and then reports it, and they go over the 7 years?
No, it's super rare, man. We call those zombies, and they're super rare. And mind you, man, I mean, between me and my analyst, man, we're looking at a lot of credit reports every day. I mean, easily 30, 40.
Right.
So we're just not seeing them. They'll stick out, right? Because you'll see a creditor that reports to all 3 bureaus and it's just on one.
Right.
Because for some reason it's sticking around there. But the reporting agencies have pretty well got that wrapped up. There's been a lot of lawsuits over gotchas like that, and so they've got their data pretty locked down to where, and that's a pretty easy date to catch and to count. So we just don't see them.
And I don't think people know that the credit bureaus, they obviously charge us to pull credit, and every year it keeps going up like inflation. It's more expensive. But then they're also charging the people that are reporting the data to them to report it, right? Like if Ford wants to report to the bureaus, they're charging them to report that?
I think so, Josh. I don't know that. I don't know that for sure. I think they do, but I don't know for sure.
Okay, so what about the trigger leads? When I pull someone's credit, then they're selling all the data. How are they allowed? I mean, that's the craziest thing for me in the mortgage industry is how you pull somebody's credit and then they get 1,000 phone calls the next day, or they get
literally.
30 phone calls, and they're trying to work at work, and everybody just keeps calling them, and then I call them spam calls, but they're just getting called by everybody, and the bureaus are just selling that data to people that
Yes.
buy it, saying, "Hey, Eddie pulled his credit, he wants to buy a house."
Right, right. Trigger leads have been there for decades, man. It was just, we're in such a different market now to where these huge call centers, the big mortgage centers are desperate for business because origination's down and closings are down. And so it's just starving pariah, swarming on a piece of meat in the water. So, but what I tell people is, and what I suggest you tell people too, is when you first talk to them, you can soft pull, which is great. I always suggest a soft pull. That way you can get an idea of what they got. But if they'll go to optoutprescreen.com, so OPTOUTPRE screen.com, they can do a 5-year opt out. It's directly with the bureaus, and it's going to opt them out not only of the trigger leads. Man, it's going to opt them out of all the credit card pre-approvals and One Main Financial and all the stuff. Half of the stuff in your mailbox are credit offers. So it'll wipe you out of all of that for 5 years. My wife and I are, God, we're 17, 18 years into opting out, man. And when the 5 years is up, you go to your mailbox, you're like, oh, it's already been 5 years. You can just tell. So, and another thing, too, that's really important for consumers, they need to opt out every time they move. They need to opt out of the address they're in, and they need to plan ahead. If Capital One has a list of 1 million people in their system and they're mailing letters next month or pre-approvals next month, well, you might opt out next month, but they already got your data for this month. So if you're moving, coming up, opt out. That's one of the biggest ways fraud happens. You move, pre-approved credit card comes there, somebody's tempted to open it up because that address still matches.
Well, what about the don't call list.gov? Does that still have the same impact?
You asked me about this the other day, and I didn't do any research on it.
Yeah.
But I don't know. I think it's worth doing. Meaning, it may help the honest companies out there not to bug you to death. But I just don't know.
But does the credit bureaus put the trigger leads that they sell out to people, or is it the job of the person? I mean, because if someone's buying a trigger lead, right, and they're on the don't call list, why would they pay for that lead from the bureau, right? So
it's an opportunity.
Does the bureau scan the don't call list to know who's on there, not to sell the data?
I think we're talking about two different things. I think the do not call list, it has nothing to do with the reporting agencies. It's just a national registry that if your phone number's in there, they're not supposed to call you. I just don't know what department of government or what capacity of enforcement they have, right? You're on the do not call list and they called you, and you report them.
Right.
I mean, are they going to get in trouble for it? So I think it's a smart thing to do. Just it's easy, like opting out, and it'll keep the honest people from calling you. But I'd be shocked if it eliminates all calls you don't want.
Right.
But look, the trigger leads is just a part of it. I'll tell you something else too, man. The reporting agencies have other mechanisms too that trigger. So, as we're helping consumers, or they're doing it, we're paying debts, paying down, paying debts, getting this collection, getting that one off, paying this one, paying that one, go. Bam, dude, a collection will pop up out of nowhere from years ago. Wasn't on there, no way, got letter in the mail, no way to stop it. It's just bam. Well, guess what? All that activity of paying debt triggered that deep search for this collection. Some computer's going, hey, Sally and Bob are paying a bunch of accounts. You got any debts out there? Somebody goes, I got one. Well, give it to me. Let's put it on the credit report. Okay. And it pops up. Man, I see that often. And honestly, those are the most frustrating, because you call them up. Hey, what address do you have? Well, they hadn't lived there in 5 years. What phone number? Didn't contact or whatever. Even if it's not right, whatever your reasoning is, and you want to pay it, and a lot of times they won't delete it, man. And it's just it's frustrating. It can stop a home loan.
I mean, that's happened to me with somebody with a car, right? That it was charged off, and then whatever we had to do, re-pull a new credit report, and now the charge-off's is zero balance, and they sold to a collection agency. Now I'm having to count the collection percentage.
Yeah.
Even though the original creditor charged it off.
FHA's 5% rule. I know.
Yeah.
Hey, you mentioned before that, and I should know this, but I'm not embarrassed to say I don't know something. VA has the 5% rule, right?
Yes, they put that in recently.
Yeah, I noticed.
They used to not. You didn't have to count it at all. It was kind of more of an underwriter discretion, but now they put it in there kind of similar to FHA.
Yeah, and I think a lot of consumers and even lenders don't know that you can get around the 5% rule with a documented, and I can't emphasize or bold, documented payment plan in at least 3 months worth of payments. And then that payment amount can go into the ratios. And a lot of times that,
But some of those collections companies seem pretty smart of not accepting those payment plans, knowing that they're trying to buy a house.
I
Just
don't,
to split it
I
up.
don't know. I don't know. I don't know that they're, even though they have the ability and the legal ability to check your credit, I just don't know if they're diving that deep into something. I mean, look, if it was a $57,000 collection, they might take the time to look at your credit report, but I don't know. They're also different. All these, when you think about all the companies that report to the credit report and all these collection companies, they're all individual little bitty businesses, and they all have the picadillos, nuances. There's really not a stamp of this company. I mean, there's more in common with the Citibank credit card, Discover credit card, Capital One. There's more in common with how they do business than all these unique, what I would maybe call mom and pop. There's some huge collection companies, but more the unique boutique collection companies, if you will.
What? Okay, so someone's gonna pull their credit for a mortgage. What's the true window of not affecting your score or having multiple pulls?
With the models that we're pulling or that we're using every day, the 5, 4, and 2, it's 14 days. So all inquiries in the same 14 days count as one. And it's really important to note too that the inquiry today is only in a score 31 days from now.
Really?
Yes. And so, and believe me, man, that's bit us before, because let's say we're doing a rescore or, updating an account in a couple of days, or we're doing a longer plan. It's over a month. Well, if you don't go look at the inquiry section, you don't see this barrage of inquiries that aren't in the scores yet. And maybe they're within 14 days, maybe they're not. Maybe there's about to be 2 that hit the next 30 days. And depending on how many total inquiries they have for the past 12 months, those 2 can be really impactful. I mean, you could lose 10 to 15 points, and that throws off your prediction of scores. There are situations to where I'll tell a lender, you've got to rescore this. Well, man, they're not going to buy a home. I mean, they're not buying a home till August. Why can't we just wait? I said, well, because these inquiries are about to hit scores. And if they hit it, I just don't think you're going to be at that 700. So we got to hit scores fast, hold them so that you have 120 days to close the loan, and we can lock that report and score in.
Right. Yeah, a lot of people don't know that when I pull a credit report for a mortgage, it's good for 120 days. Now, that's 120 days to close, not to go find the house. So usually you got to be within day 90 to 100 to be able to close within that 120 days.
Another thing I tell you too, as soon as you pull their Credit Karma's going to say your score went down. Oh no. So if you could warn the borrowers, hey, look, just know all your free scores just don't work that way. I'm about to do a hard pull. It's not going to be your scores for 30 days. You're probably going to get an email from some of your monitoring servers that your score went down. Just ignore all that. Just always ignore those scores. This is part of the process, and it's not going to affect the scores I'm pulling today.
Right.
Some people, you can't pull my credit.
Well,
Have you ever had somebody, Josh, I want to buy a home, but you can't pull my credit? And you're like, there's no other way to do it.
I had someone the other day, they did a full app, clicked on everything, even for me to pull credit, and I got the app, called, they didn't answer. So, it was a full app and everything was answered. So I pulled the credit, and then all of a sudden, I didn't want you to pull my credit. And I'm like, well, how am I supposed to even do anything? Yeah, I guess I could have done a soft pull, but I don't really pull a lot of soft pulls because, for me, I really can't run that,
No.
And for me to pull a soft pull, then go to a hard pull, it's just more of a cost. Credit reports aren't cheap. They're super expensive.
No, it's all expensive. I remember when soft pulls were, $5 a bureau, and now they're 20.
They're more than that now.
I know. So,
I mean, the only time I pull soft pulls is like if I'm going to, they're going to close 9 days later, I'm going to see if the score went up. I'll pull a soft pull.
yeah.
Before I go pull a hard pull.
Yeah. No, I get that. It's just, it's just gotten really expensive. When I tell consumers that they need to go to MyFICO, get the premier service, pay $40, like $40. I'm like, yeah, man. A mortgage report is 90. A joint is 160, 70. Gosh, Josh, I remember when they were like, what, $38 a
30
couple.
bucks. Yeah, remember back in the day with Sarma, we were paying $28 for a tri-merge. It was nothing.
I know. It just got really expensive.
It's crazy.
Well, look.
Well, Eddie, hey,
Go ahead.
go ahead. I didn't mean to cut you off. Go ahead.
I'm done. I was just going to go off on some tangent, but I'm good.
No, I was going to say, hey, it was great visiting with you about credit. Hey, Eddie knows so much about credit. If someone out there is wanting some help or questions, Eddie, how do they find you?
Man, call my office, 972-820-0342. Mary and Mindy are awesome. They'll get us ready for a phone call. We can figure it out and just take it from there.
Can they find you online?
Yep. At creditsecuritygroup.com. And
how many reviews are we up to?
We have 507 Google reviews, and they're 99.6% 5 stars, meaning they're all 5 stars, but 2.
Hey, if y'all are looking for results in the mortgage world and even have questions to learn about credit to impact you down the road, even if you're not buying a house, just wanting to know how to make it better for buying a car, get a credit card, reach out to Eddie. His firm is top notch, and I've never had anybody that I've ever referred to Eddie that was a bad experience, and everybody got help. So reach out to Eddie. You can find him online. He gave you his number. Again, everyone, thanks for sitting in, listening to us, and Eddie, thank you for your time today.
Thanks for having me, Josh. Man, have a great night.